Okay, on my clock, we're a couple of minutes past 12, so I think we'll go ahead and get started with the webinar this afternoon. Once again, thank you for joining us for this version of the Tartan Talks webinar series, Financial Fundamentals, Tools for Pursuing Financial Health, with alumnus Josh Brehm. And before we get started, just want to review the ground rules a little bit for how we approach the Tartan Talks. As I've mentioned already, we will ask everyone to keep their microphones muted throughout the presentation, just so it helps cut back on the background noise and feedback in the system. We will use the text chat feature to pose questions. And if you have the webinar pulled up on your tablet or on your computer, if you scroll over the screen, you'll see a menu bar appear at the bottom of your screen, and there should be a little chat bubble. If you click on that, that'll open up a separate small window that is a group chat feature, and you can pose your question in that chat box, and you can send that to me, Bill Arnold, or you can just post it to the entire group, either way, and then I will present the questions to Josh during the presentation. What we try to do is we will hold most questions to the end. We try to have about 5 or 10 minutes of question and answer time at the end of the presentation. But if the question is something that is a clarifying point to something that Josh talks about at a particular point in the webinar, certainly we'll interject those to make sure we get that clarification. But then we will handle most sort of general question and answer and discussion in the last 5 or 10 minutes of the presentation. We are recording the webinar today, and we'll make that video available to folks who are participants, and then we will also post that on the Tartan Talks website so that you can go back and re-listen to the webinar at another time if that is something that would be helpful for you. Well, I think that covers all of the basics right now, and so at this point I would like to go ahead and get started, and I'll introduce Josh Brehm. Josh is a 2006 graduate of Alma College. Josh joined Merrill Lynch in 2013, is currently the Senior Vice President and a financial advisor there. Josh has experience in liability management and asset accumulation. So he is an expert in this area and has generously agreed to share some thoughts on basic financial fundamentals on how to help people pursue income and growth in their investment pieces. So Josh, I'm going to turn it over to you and let you take it from here. Thanks again for being here.
Thanks, Bill, and thanks everyone for joining. Obviously, this is something that is good to be considering, especially this time of year with tax refunds rolling in. I know it's always a challenge to decide what to do. So we'll talk about goal setting in terms of how to manage your finances. That's going to boil down to creating a spending plan, which we'll talk a little bit about. We'll talk a little bit about credit, and then we'll talk about different goals and how to make sure you have enough in savings, but also are you doing enough for your future goals, whether it's retiring or helping kids, your own kids through college or buying a home. Those are some of the common things that we see. So as Bill said, if there's questions, just please ask through the chat service, and we'll get those answered. And with that being said, we'll get into this. So as with anything, goal setting, if you write down your goals on a regular basis, you're much more likely to achieve them. I think that's is something you see both in whether it's career aspirations, with your marriages or relationships, and also flows through with financial goal setting. If you write them down and hold yourself accountable, review them on a regular basis, that will help achieve those goals. So start by doing that. And as I mentioned, some of the common goals that we see for whether it's clients or children of clients, identifying what's important to you. You know, when do you want to retire? Do you want to be debt free? owning a home, buying a car, traveling. These are some of the key things that clients look at. So it's really important to identify your goal. And we always encourage people to pick the house that you want or pick the car that you want and actually visualize it, because that visualization, much like writing it down, is key to helping you achieve those goals and let you make or I guess forces you to make those hard decisions when you're, talking about going out to dinner or, saving that $50 for your goal. It's important to be able to visualize that goal. And again, this is kind of maybe somewhat basic, but having clearly defined goals. Why is it important to you? What is the purpose? Give yourself a timetable and a specific dollar amount, and what actions do you need to achieve it. So, and everyone's financial goals are very personal and also very we don't see two financial plans are the same when we're working with our clients. Some people, to do what they want to do, need $5 million. Other people, to achieve the lifestyle that they want in retirement, can do it with $100,000. So a lot of people want to say, how much should I have? How much should I have? And I always kind of revert back to how much do you want, or what are you trying to achieve with retirement? And that will help us decide, what you need to be doing today to achieve those goals. And then making things a priority, whether it's paying down credit card debt, paying off student loans, buying a house. It's good to have these goals layered in a logical, reasonable way, so that you're doing what's most critical first and then diving into the bigger goals later on. And then holding yourself accountable, small steps, sharing your goals with others, surround yourself with people who are doing what you would like to do, and then monitoring progress. There are a ton of applications that you can use, or, I have a lot of clients that do Excel spreadsheets that keep track of, their essential expenses and their non-essential expenses. And it's, I always compare, financial planning a lot to dieting. I think writing down a food log or a food journal is very eye-opening for some people. I think if you took the time to monitor what you're actually spending your money on, it would be very eye-opening for you to potentially see where you could cut back in areas, or where there's some slack in the rope that you could tighten up and, very easily achieve your goals. Again, if you don't know where you're going, you'll end up somewhere else. So having a plan in place. Most of our clients that work with us have a monthly goal or an annual target that they're trying to hit in terms of savings. And then, once they flip the switch, so to speak, and they're retired, we give them a number that they can take every year and achieve the lifestyle and be able to do everything that they want to do, and i.e. not run out of money, or if they have a specific goal in terms of what they want to leave to the next generation, making sure that they're hitting that target for them. So again, this is very important to have a plan and hold yourself accountable. So specifically a spending plan, you're looking at the money coming in and going out. You want to find a balance. Obviously, there's going to be months where you're, some people are negative, but that's the key thing, to have some savings to cover you through that period of time. And then, because there's always the one-off emergencies, whether it's an appliance or property taxes, homeowners insurance. Those are some, bigger expenses for people. So it's important to know that, net for for a year, what are you adding to or taking from your cash reserves? So step one of creating the plan is going to be write down everything you spend money on, and then write down your take-home pay. I think it's very common that people talk about how much money they make, but they talk about in gross numbers. They don't talk about the net. For most of us, if you look at our most costly piece of our spending in a year, are taxes. And I think it's most overly looked. That's, for most people, anywhere from 15 to 35% of your income is going to go to taxes. So, making sure that you don't get jaded by the gross number and think, oh, I have $100,000 salary, I can spend $100,000 a year, when in fact, if you look at what you're netting after taxes and medical, vision, dental, if you're doing a 401k, it's really important to look at that bottom line net number. And then writing down everything you spend money on. And then categorizing those expenses between fixed versus discretionary, and then essential versus non-essential. So this will really show you where there's some room to cut back. And this is something that my family and I have done. We encourage all of our clients to do, and it really can show you where you can identify issues and cut back and hold yourself accountable and hit certain targets for certain categories. And then the other thing too is setting up a spending plan. Our society is very credit card oriented. So if you have a credit card, you can go pretty much get whatever you want whenever you want. And there's an instant gratification of buying it, or retail therapy. There's a lot of impulse purchases, especially with Amazon. I know that anyone right now could pull up their Amazon account and have anything at their door in a couple of days. So it's really important with our society and the way spending has changed over the last 5 to 10 years that we have some accountability with it. And one of the tips that we suggest doing is, waiting 72 hours to see if it's still important to you. I've heard of people that will take their credit card. I think this is a little extreme, but take their credit card, put it in water, and then put it in their freezer and freeze it, so that they have to wait for their credit card to thaw before they can actually buy anything. So again, whatever the means are, I think it's just important that you take some time to consider if you truly need something when going to purchase something.
Hey, Josh?
Yes.
Before you move forward, you had a couple of comments there in quotes: spending leaks and found money. What are those specific terms, or is it just kind of getting a different way of talking about what you were mentioning?
Yeah, good question. So spending leaks are frivolous expenses that maybe you signed up for a magazine subscription 5 years ago and you haven't looked at the magazine ever, and it's still charging your credit card. Or you're spending $100 a month on lunches at work when you could pack a lunch. So those would be types of spending leaks. Found money, you get a tax return more than you expected. What do you do with that money? What do you tend to do with that? So some people, they treat it as if it were a windfall, and it just kind of goes frivolously down the drain or for different things, whereas other people use it to kind of get ahead of, get a savings account started or fully funded. And if they have that already, maybe they look at making some contributions to retirement accounts or accounts for their children if they have children and they have goals for them in terms of college planning and whatnot. So good question, thank you. Setting up a spending plan. So I always say if you can do a 3-month spending plan to determine, what's normal. I know that everyone's budget changes on a month-to-month basis. There's never 2 months that are the same, but that'll give you the idea to figure out what are essential and non-essential things that come up. And then, do the math. If you're salaried, are you bringing in more money than you're spending? If you're bonused, are you accounting for that so that you have enough ample savings to get you through times where maybe your bonuses aren't as high as what they normally are? And again, if it's important just to sit down with someone you trust to review this, make sure that you're on par or in line with what you should be doing. And really, it always falls back in my eyes to the net number that you have on a month. Is that giving you enough to put away so that you can achieve your future goals, whether it's travel, buying a home, paying for children's weddings, colleges, retiring, whatnot. This gives you an example of how to compare income and expenses. So again, you can see at the top of the right-hand column, it says monthly net income. We talked about that. Don't get caught up in the idea of whatever your salary is on your W-2. It's really net what you get in your pocket or in your account on a monthly basis. And then subtracting out your monthly expenses will give you a net number. So in this example, it's kind of hard to see there, but they're netting about $395 per month in this example. So just important to know that there's cash flow. And with this, we'd want to see how much they have in savings and whatnot to see if they're on the right track. And if talking about debt and achieving goals, credit card debt is one of the most inefficient ways to borrow money, this is kind of a staggering statistic that 43% of credit card holders in the United States carry a balance from month to month. A lot of people have a strategy behind it where they're getting 0% for 12 months and then they'll kind of roll that balance over to another, which is great if that works, but you miss a payment, all the interest can get added back in. You're typically hurting your credit score in the long run by doing this strategy or opening cards. And sometimes they charge balance transfers. So I think it can be a Band-Aid, but the true measure is getting out of debt completely, so that you're maybe using a credit card. And this slide says, why do you use a credit card? Do you do it to get points because you don't have cash on hand, because you're getting paid next week and don't have the money? I know that there's some experts in the industry that say you should never use credit cards. It just depends on the person. Some people don't have the self-control to use it and pay it off on a monthly basis. If you can use that strategy, there are some benefits in terms of protection from creditors, from predators. If your bank account information gets stolen off your debit card, there's a police report that has to be filed, and it can be a very cumbersome process and can lead to overdrawing your account if you didn't know it happened. Whereas with a credit card, it is what it is. It's kind of segregated from your checking account. So if your information is stolen, they don't have access to create a huge problem with your personal finances. And you can get some pretty good rewards points. There's a lot of cards out there that pay a couple percent cash back or for travel or what have you. So I'm in support in a general context of using credit cards, but again, it depends on the person. And it really boils down to your individual situation. This talks about why not to carry balances on your credit cards. So interest is a cost of using credit. Average credit card interest rate in the United States is 17%. So every dollar that you use is going to cost you $1.17 to pay back. So I think if you're in the situation where you're carrying balances on your credit card, it's really important that you every time you use it, maybe you go to dinner and you spend $20 on dinner. Are you willing to pay back the $23.40 it's going to cost you if you were to carry that balance like a normal person does with their credit cards at 17%? And this, again, what you really pay. So this is looking at the average or a balance of $8,100, how long it would take you paying $200 a month. It would take you 62 months, and you would pay over $4,100 of interest at a 17% rate. So again, very profitable for the credit card companies and the banks, not very profitable for retail clients or investors. So if you are carrying credit card balance, I think that would be after you have a savings account established and up to a decent amount where you feel comfortable, the next best bang for your buck in terms of debt and attacking is going after your credit cards, because 17% is a very high rate. We talked a little bit about this earlier. We talked about credit reports and how the 0% credit card flipping can hurt your score. We always do encourage clients to check their credit report regularly. A lot of credit cards these days do have a service as part of the package, so you get monthly updates, or you can sign up for My FICO and go to the website, and you can actually pull your credit report through annualcreditreport.com, which is always a good thing to do, just to make sure everything's being reported properly and there's no issues with your credit score. And a lot of times our clients are pretty surprised when they take the time to do this about some of the things that either are or are not on their credit report, and they can help get ahead of a potential problem, because when you apply for a house or a car, you typically have one of those things in mind that you want to buy. That's not a very fun time to find out that you have an issue with your credit that you could have been working on resolving it earlier. So always encourage clients to check your credit one time per year at least, and that is free. It doesn't hurt your credit score to do that. So this gives you a little bit more. The average credit score in America, I don't know why it says 6,751, but the average credit score is 675. The below average is less than 300, and if you're above 750, that's considered excellent. So again, the credit score dictates how much you pay for. It can dictate homeowners insurance, auto insurance, what rate you get on a car loan, a mortgage. There are a lot of different factors that this can play into. So it's important that you have an idea where your credit score is and things that go into it. Which this slide is, I'm going to skip this one. It talks about credit and how it's evaluated. I have a different slide in front of me that is pulling this over. So let me pull up my hard copy here. So this talks about how lenders use to evaluate your credit risk. So these are the factors. 35% of your score is dictated by your payment history. 30% is dictated by how much you owe. 15% is the length of credit history. And this is one that we commonly see as a problem for clients. So you have a $10,000 credit card balance, you pay it off and you're ultra excited. You decide to close that account. If you close that account, you lose all the history that you had while you had that credit card open. So it's as if though it never happened. So that can lead to a decline in your credit score. So it's important that if you have a credit card that you've had for a long time that has a good pay history, meaning you've never missed a payment, even after you pay it off, we would recommend still keeping it open. Maybe you change the limit, but if you were to go through and close all of your credit cards, no credit is the same as bad credit when it comes to banks and borrowing money. So having an open line of credit is something they look at. And then the other two factors that go into it are what types of credit are you using and what types of credit are you carrying balances on. As we just mentioned, credit cards are the most inefficient for clients to use. So if the credit bureaus see you carrying balances on your credit cards, they're automatically assuming that something's wrong. Maybe their budget, the person's budget isn't strong enough to support their lifestyle. So they kind of will ding you up to 10% of your credit score based on carrying balances on credit cards. And then establishing a lot of new credit, that does a factor into your score of about 10% there. So those are all the things that go into credit. And I think the things to walk away from is use the right type of credit, pay your bills on time, keep your cards open. And the amounts owed, it makes up 30% of your score. What that comes down to is revolving utilization. So I always use this example for clients. Let's say you have a credit card limit of 10,000, you have a balance of 5,000. That credit card utilization would be 50%. Generally speaking, the credit bureaus like to see that your utilization be 30% or less. So, and that's based on when the information is reported to the credit bureaus. You could pay off your credit cards on a monthly basis, but if when that information is reported to the bureaus, you're at 70% utilization, that over time can hurt your score. So it's important to try to, I have some clients that make multiple payments to their credit card every month just to keep their revolving utilization down below that 30%. 30% threshold, and therefore helping keep their credit score higher. So there's we're not going to talk too much more on credit cards and credit, but you can definitely do some research online, or if you have questions, I'm more than happy to help, talk offline. So once we identify, the type of debt we have, there's a couple different strategies on how to pay it down. So figure how much you owe, stop charging new items, keep only 1 or 2 cards with no annual fee, and then transfer balances to lower interest rate cards, which we talked about, and then paying more than the minimum. And that is a huge value. Just because your payment's $25 a month doesn't stop you from paying a couple hundred if you have the extra money that month. And the 2 different methods for paying your debt down, there's the snowball or low balance method. And then there's the high interest rate method. From a psychological standpoint, a lot of clients like to do the snowball or low balance method, because that way you're just organizing your credit cards or your debts from lowest balance to highest balance. And once you pay off the lowest balance, you take that money that was being allocated towards that and pick the next one. So you're getting the gratification of paying off bills and stop the cash flow. And what tends, if you look at most people's situation, the lower balance debts are typically the higher interest rate debts, i.e. credit cards, student loans, car loans. Most people's mortgages are fairly decent rates these days. So the snowball is my chosen way of going about it for clients. Mathematically, the way that makes the most sense is paying off the highest interest rates. Again, for a lot of clients, it's tomato with this, but mathematically, if you're paying off the highest interest rate cards or debts first, you're going to get out of debt faster with paying less interest. But sometimes people get discouraged when they're not seeing the results of completely paying off a balance. So that's where the snowball comes in a little bit better for some. So once you have, consumer debt down to a minimum, and consumer debt I'm talking about, or completely eliminated credit cards, car loans, student loans, mortgages are okay. Then you can start talking about saving for your goals, which is going to, a lot of people look at buckets. Enlisted as a fixed item in your spending plan. A lot of people kind of look at the mortgage and the car loan and the groceries as bills. I think the truly really good savers that we see have a line item for themselves, where before they quote unquote pay their mortgage, they're paying themselves, and that means they're putting money in savings on a monthly basis. So it's always good to add that to your spending plan. In terms of compounding, the rule of 72, which is you can take the number 72 and divide it by your expected rate of return, and that will show you or tell you how long it will take your money to double. So if we just say, and if you have an investment, a 401k, what have you, and you're earning 6% per year, that account with no further contributions would double in 12 years. So if you're more aggressive and you can earn 10%, that would double in 7 years. So I think it's important to know how compounding works, and also know that the sooner you start, the longer the money is invested and the more time you have for compounding. Tips for pursuing your goals, make trade-offs. We talked about tax refunds. What are you going to do with that? Are you going to save it? Shopping around for whether it's car insurance or cars, or buying used instead of new, and adjust your goals as necessary, right? So maybe you're saving $5,000 a year into your savings account. Is that enough to get you where you're going to go, or is that more than enough? And can you, par it back a little bit depending on your situation? And another strategy that a lot of clients have used is, as they get raises, they increase their savings so that their net paycheck is about the same as what it was even after the raise, which is a great habit to get into. The first thing I always encourage clients to do, building an emergency fund. That way you have unexpected expenses covered, which would help you. If you have that savings account, you can use that money instead of carrying a balance on a credit card. And then also potential loss of income, you have some cash set aside for that. Typically, depending on the profession, 6 months is kind of the general rule of thumb for 6 months worth of income in savings. Some clients don't feel comfortable unless they have 12 to 24, others even more than that. So it really depends on the situation, but I would say target at least 6 months. And then once you have that, then you can start talking about retirement and saving for that, increasing contributions on a regular basis, knowing what the income limits are and the catch-up contributions limits are based on age. If you have a financial advisor, they should be able to provide that information for you, or your accountant. If you do have a professional do your taxes for you, they would be able to help with that. I know we're kind of getting toward the end of our timeline, so wrapping up, write down your goals, create a spending plan, manage debt and use credit wisely, create a savings plan, and review your goals on a regular basis. So then we also included some resources that you can go to if you wanted to kind of get some more information on those, or if anyone has questions right now or at a future date, there's all my contact information. I'm more than happy to have a quick call with anyone regarding any of the material we covered here today.
Great, thanks, Josh. This was really helpful, and as I said, we'll have a few minutes here at the end to take questions. And going back a little bit, and this is something you can actually provide an answer on or not, Josh, but someone asked about the credit. You were talking about checking your credit score, and somebody asked about whether you know if Credit Karma is reputable. I don't know if you know names of some of those credit monitoring agencies, and if there are some that you find more reputable or not.
It's a good question. I've heard of Credit Karma. I've never personally used it or have had anyone use it that I'm aware of. I'm sure it's probably a great service, though I would always defer back to I'm going back to the website, annualcreditreport.com. I know some of those Credit Karmas, I've heard that they require you to type in a credit card, and then all of a sudden you're signed up for the subscription and things like that. So I would just be careful, but annualcreditreport.com is definitely one you can go to. And I would check with my credit card as well. They may have a Credit Karma type product attached to your card that allows you to check it with no additional signing up or maneuvering. You just have to click on a certain link on the website and it'll let you in there. So good question.
Okay. Another question is, you mentioned, 401ks as a piece that some people have in terms of their benefits through their employer as an investment area. Is that enough, or do you recommend that, in addition to, if you have a 401k through your employer, that you should have some additional investments?
Yeah, it's a good question. It really depends on the situation. For some clients that I work with, they're contributing to a 401k and they're not even maxing out that 401k, and that's going to be enough for them to hit their targets. Other clients, I have husband and wife both maxing out their 401ks, and they still need to save money in other type of investment accounts to hit their goals. So I think that's I think more is always better if possible, but again, it's important to be able to enjoy the fruits of your labor today too, because you never know how what's to come. So I think it's a fine line, and really looking at each individual's personal goals would be the only way to truly answer that question.
Okay. Are there, if folks have any other questions, again, feel free to put those in the text chat area. If you scroll over your screen on your tablet or computer, you'll see a little chat bubble there, and if you click on that, you can post a message in the chat, and I'll present that to Josh. But I think there were a couple that have come up that you've already addressed in some of the slides that you've presented on. So, and again, Josh offered to take questions. I know sometimes people, if you have personal questions, you might want to talk with Josh directly, and his information was there on the last slide. And again, we will be sharing this recording of this session, so you'll have a chance to go back and visit that. But just wanted to take a moment again to say thanks to Josh for volunteering his time to do this and sharing all this useful information. As he and I were talking earlier before we got started, some folks are a little uncomfortable talking about finances, and so I think this is a nice, safe, kind of comfortable way to at least get some introductory pieces, and I really appreciate Josh taking the time to do that. So thanks, Josh.
Yeah, thank you. And Bill, thank you for putting on this series. I think everyone's found a lot of benefit, not only in this one today, but all the others. So I encourage everyone to, get back and stay in touch with Alma. There's a lot of good things going on with the college. And again, if there's anything I can do offline for anyone in terms of questions, please feel free to reach out to me. My contact information is, I'll scroll to that here so you have it, or you can get it. Bill has all my contact information as well. So again, I appreciate everyone's time today.
Okay, great. Thanks, everyone, and keep looking at your email and the website for upcoming Tartan Talks.